Okay, peeps, welcome back. So today we're going to be going over the market macro indicators for March of 2024. Try to say that 3 times fast. Let's get it. Okay, so there's a few things we're going to go over before we go over the SPX. A few different things to watch out for this particular month or basically going forward. First one's going to be the fear and greed index. So there's two separate fear and greed indexes. There's one for crypto that we look at for crypto, and then there's one for stocks. This one is for stocks, or basically traditional finance. So based on looking at the overall view here, you guys can see we're in the greed territory. We got pretty close to that extreme greed, so very borderline extreme greed. We've kind of pulled back a little bit since then. But we're still up massively from a year ago, as you guys can see, 49 on that count. So based on all these metrics here, you guys can see we're at pretty much extreme greed for almost all of these. So you have your market momentum, stock price strength, price breadth, put and call options, and then safe haven demand, which is probably going to be like your precious metals, treasury bonds, cash, stuff like that. So not as greedy as the actual risk on assets, and then junk bonds. So yeah, I would say this is probably going to be your higher yielding kind of bonds right here. So the only thing that is remaining neutral is the market volatility. So markets have not been super volatile lately, which I suppose is a good thing, but it could also not be a good thing. Maybe it just means that the markets are normalizing and we're just going to keep going higher, or maybe it could potentially be an omen that markets might have a pullback on the horizon soon. We don't know yet, but we're going to take a look at that here soon. So Fed Watch tool, this is another thing we keep an eye out on. Why? Because the Fed has been holding rates for eons, it seems, and at some point in the future, they're going to cut. They have to. They don't have a choice. Okay. The presidential election is going to be coming up, and well, there's two things that presidents don't want. I'm sure of this. Okay. Number one, the president of the United States is not going to want a recession when they get elected because it looks bad for them. It's not very favorable with the people if the presidential electee is getting elected, or either when there's a recession or there's about to be a recession right before he gets elected or after he gets elected. That does not sit well with the people. So number two is that the president of the United States is going to want to cut rates most likely before the election, because it's not going to look good if things are really super expensive, and it's also expensive to borrow for people and corporations come time for the election, because it's not just individuals looking at who's going to be president of the United States, which again we believe is going to be Trump firmly 100%. It's also corporations and big money and whales and banks and stuff like that, so on and so on, because there's special interests and lobbyists and stuff like that, so it's not just individuals. But anyways, so we take a look at the Fed funds rate. You guys can see that this upcoming month the market's pretty much expecting nothing to happen, so Fed's going to hold rates again in May. But if we go out a little bit further, you guys can see that there is it looks like a pretty high probability for the first cut to be in June. I would say, in all honesty, I'm not sure about this one. Okay. The Fed has said that they're going to wait longer, that they're only going to cut rates 3 times this year. Well, there's three. The last 3 FOMC meetings start in September of the year. So not really so sure about this. Initially, we thought there was going to be somewhere between, I'd say roughly about 4 to 8 rate cuts, probably closer to 6 to 8, but the Fed kind of rug pulled everybody and was like, no, we're not going to do that. We're going to wait longer. They're doing the usual thing that the Fed always does during tightening cycles. They're pretty much, they're not, I'm not going to say they're trying to force a recession, but they're waiting too long, in my opinion. They're waiting way too long. They should have been cutting before September of 2024. So we're going to see if that's going to happen or not. But with all that being said, I'm just not so sure about this rate cut in June. So we'll see about that one, but that's what the markets project. So 1 rate cut in June, no rate cuts in July, potentially another rate cut in September. Well, let's actually go back here. So yeah, another rate cut in September. Looks like, again, no rate cut in November and potentially one more rate cut in December. So, yeah, okay. So basically, it looks like, the markets are expecting like a cut and a skip, something like that. Which, when you think about it, looking back at the way that the Fed hiked rates, it would kind of make sense when you think about it, because for a while there, they were basically doing like quarter basis point hikes every other meeting. So this would pretty much be the inverse of that. So it kind of would line up with the historical of what they've actually done, not just what they said they were going to do. So CPI is another big one. April 10th, that's coming up this month. That's going to be a big deal because, again, that is going to be before the next FOMC meeting, which is going to be pretty much at the end of this month. So that's something to keep a lookout for. This will obviously have some kind of an impact on what the Fed will or will not do in this upcoming FOMC meeting. So with that being said, let's get into the charts. So SPX is looking very bullish. Ever since this breakout in October, we have just been straight up. Just so you guys know, just taking a look at this, it is a pretty large increase. We've had about, it looks like roughly about a 20% increase since that breakout. And we did tell you guys about this back then. So yeah, roughly about 20%. So a big deal. We have crossed over the all-time highs. So that's also very bullish. That happened just a few months ago. So back at the start of the year. Something else I want to point out to you guys is the last time we were in a major bull run like this, you guys can see that after the pandemic pullback, we had this pop to the upside, and then we basically just rode these EMAs all the way up. We're kind of seeing something similar here. So this could actually be, this breakout right here could have been the start of a new, multi-year bull run. That's possible because the price action on the two look very similar. Now, do keep in mind when the Fed cuts rates, generally the markets dump. That's usually what happens. That's just been the historical norm. There could be a lot of different reasons for that, but that's usually what happens when the Fed cuts rates. The last time that happened was back in 2020. We've stated on this channel that we think that because the bear market was so brutal in 2022, while the Fed was hiking rates, which is the opposite of what historically usually happens, we think that the markets will go up as the Fed cuts rates. So basically, the way it usually goes is the Fed hikes rates and the markets go up with the rate hikes. When they cut rates, the markets go down with the rate cuts. We didn't see that this time. The markets went down as the Fed was hiking rates. So therefore, we expect the markets to go up as the Fed's cutting rates. That's kind of what we're expecting. So now in terms of levels, one more thing here. So we are in overbought territory on the RSI. If I could just pull it up real quick so you guys can see this shade of green starting to come in here. Not as obvious as this one back here, but something to keep in mind. We are in the overbought territory, so a possible short-term pullback could potentially be on the horizon, especially with these EMAs being so fanned out. But if this thing does pull back, I would say it's going to pull back somewhere into this zone here, so somewhere between 4,600 to 4,800. It could possibly also be stopped at that $5,000 level. So you guys can see it kind of stopped here temporarily, and then it busted out of there. Why 5,000? Well, it's quite simple because, again, even numbers, that's a major psychological number for traders, kind of like 4,000 was. So as you guys can see on this drop here, we stopped just shy of 4,000, so we're at 4,100. That's clearly another indication of potentially where we could bounce from. So maybe 250-point drop to, I don't know, 4,400 points, or not 4,400 points, 440 points, somewhere in there. So we'll take a look at the SMA now. This is a simple moving average. Generally, this is our bull bear market indicator. So we only ever usually look at this one on the weekly, not the daily or anywhere else. Why does this one matter? I'm going to point this out for those of you guys that are new to the channel. The reason this matters for stocks is because, as you can see, going back as far as the eye can see, unless the markets actually went into a recession, this thing has served as a bounce zone. Okay, it bounced in 2011, bounced in 2016, bounced in 2018. Kind of had a fake out here in 2020, but it did eventually get back up. And then we more or less bounced in the bear market of 2022, and we almost touched it back in 23, but we also bounced well above the 200-week moving average at that point. So a very important indicator for indicating whether we are actually in a true technical bear market or not. So that indicator currently sits at roughly about 4160. So that's pretty much right around the same level that we bottomed out before the breakout in October. Do I think it's going to get back that low anytime soon? No, I do not. Honestly, I really, really don't. So don't think there's too much to worry about there. Okay, so I didn't want to do that. Sorry about that, fellas. So give me a second here. Let's move over to the 51, which is our day trading indicators, just so you all know, the 8 EMA, 21 EMA, 51 EMA. So here we have on the NASDAQ, you guys can see very similar. We are very bullish on this. The MACD looking like it's about ready to have a death cross could indicate a potential pullback in the markets. It's not so obvious on the SPX, but on the NASDAQ, it's starting to look a little more obvious, so have to keep a lookout on that. We'll keep you and guys updated if we see something like that show up. So support is between about 16,000 to about 16,900. And we are at highs right now, as you guys can see. So if it does pull back into the zone, you could be looking at somewhere around an 8 to about a 12.5% correction. That would be normal for a typical 1 or 2 time a year pullback in the stock market. That's not really that out of the ordinary, in my opinion. And history does kind of support it. You guys can see we had one big pullback last year, and that was it. And then we basically just went straight up. So Russell 2000, we finally got above the zone. It actually just happened this month, or in February, early March, as you guys can see, and we are pushing up. So the next area we could get to is pretty much where we're at now, 2140, but above that, you'd be looking at roughly around 2290, 2300, somewhere in there. So for that move, you could be looking at as much as about another 9% on the Russell 2000. We'll just have to kind of wait and see on that one, but it has respected all these trend lines. It has not broken them. It has to flip this resistance into support. We had a golden cross back here during December of last year. It is above the EMAs, so everything looks very bullish. The RSI is not overbought, so that's a good sign. If we do have a pullback and a retest of the zone, which we have actually technically already had, it'd be about a 5% pullback, so not that bad. You guys can kind of see that once we got out of it, we came back and retested it for a few weeks before popping off. So Dow Jones, this one is also sitting at all-time highs. It does kind of look like the EMAs, or not the EMAs, the MACD on the weekly wants to curl over, but it's not as obvious as the one on the NASDAQ. So again, that could potentially be a early warning sign that maybe a pullback is coming. So the EMAs sit strongly within the same support zone that we just broke out of. So that's a very bullish confluence there. If this thing pulls back, I'd say it's going to pull back into the zone somewhere. So roughly about 35,800 to about 37,200. And if we get a pullback into that zone, it's, I mean, it's going to be a decent amount, but it's not going to be like crazy, like 50%. So 6 to about 9%. Believe it or not, that's actually a lot for stocks. It's not a lot for crypto. Most crypto investors are like, yeah, whatever, 9%, who cares? Like, I'm just going to buy the dip. It'll be up another 50, 100, 200% tomorrow, right? But for stocks, is a different story. 9 or 10% on any stock, ETF, or even an indice, especially, that's kind of a big deal for people in traditional markets. So now we'll take a look at the stocks above 50 and 200-day moving averages. So we're pretty much in no man's land on the 50-day moving average on the NASDAQ. Neither bullish nor bearish, just kind of sitting around. We're closer to the sell zone than we are the buy zone. So obviously the perfect time to buy is down here. Perfect time to sell is up here. We did hit that sell zone and sold back down. So it took some risk out of the market, which means it now has the possibility of going up further. which we have seen. But definitely not an ideal place to either buy or sell, just kind of somewhere in the middle. These indicators, the 50, 200-day indicators, are more so for position traders that are just sitting on cash looking to get in at the perfect time. This is probably most likely a tool that smart money and also whales use. I would not be surprised. So something to keep in mind here. So this is the S&P version. We're much closer to the sell zone on the S&P one than we are on the NASDAQ, which is interesting because tech usually is more frothy and explosive than the S&P is. But as you guys can see, we're not in either zone yet, so this one's a little bit more overbought than the NASDAQ. Just keep that in mind. So NASDAQ above the 200-day moving average, still very bullish. The previous peak was at 87, so we could still go up another 10%. That's possible. We're not in the sell zone, but we're not in the buy zone either, so somewhere in the middle. But don't really know which direction it's going to go yet, so we'll see. There's no clear indication as of right now as to where it's going to go. I would say the charts are probably more indicative of a reversal than this. The S&P on the 200, though, we are getting very close to that sell zone, so do keep that in mind. The buy zone here is, well, we're obviously very, very far away from that. If we get to either one of these zones, we'll be sure to let you know on X, okay? So next thing is the inverted yield curve. We have not had an inversion yet. Generally, the 2-year would be lower than the 10-year. In this case, it is higher than the 10-year. So I just want to reiterate one more time that we're probably not going to see that until the Fed starts cutting rates. Generally, there's not an uninversion of the yield curve, like a big uninversion. We're not talking like, a little fake out where it uninverts for like a day and then it goes back to inversion. We're talking like a full on uninversion here. So we're probably not going to see that until the Fed cuts rates. I would say, I would say it's likely at this point because they're just not doing anything. I mean, the Fed's not hiking, but they're not cutting. They're just kind of like wait and see, right? So there is that. Fed funds rates, obviously you guys can see it's still the same. If we click on it, basically pretty much since July of last year, so 9 months now, they pretty much have done nothing. They've just kind of been sitting there like, oh yeah, okay, we're just going to wait another meeting. One of these days they're going to cut. So there's that. Inflation, kind of not really doing much, but keep in mind, inflation does not generally go up in a straight line or down in a straight line. It kind of has pullbacks along the way, as you guys can see. We went down, then we kind of chopped, went down, chopped, went down, chopped. I expect something similar here. So at some point, we're going to get that big drop in inflation where it drops underneath 3.2% down to like 2.5%, 2%, something like that. Core, this is the unemployment rate, my bad. So core, which is a little bit more sticky, you guys can see it is chopping, but it is still trending down, so that's a very good sign. MACD here indicates that the top was in back here in August of 2022. And MACD also indicates that the top was in basically pretty much right before it crossed, actually, so about June, July timeframe. Okay, so unemployment, this is a little bit more important. So as you guys can see here, we did have a golden cross on the MACD. The unemployment rate is slowly starting to move up. That is a little concerning. We do not want to see that. So we want to see those numbers remain relatively flat. As you guys can see, once we get a golden cross here, the unemployment rate just really starts just getting out of control. So definitely not something we want to see. We will be keeping a very, very close eye on this. And hopefully we do not see something like this. But unfortunately, it looks like it is going to trend up. And hopefully that's just simply not what happens. So now we're going to go down a little bit further here over to the futures market. So let's take a look at oil. I actually don't want to be on the monthly time frame. So we're going to go over to the weekly here. Oil is starting to look kind of bullish again. Not really sure why. That's interesting. But so MACD is starting to trend up. The reason why I say I'm not sure why it's starting to look bullish is because inflation hasn't really gone up. and the US is now producing record amounts of oil per barrel per day. So yeah, not sure what's really going on here, but anywho, so the MACD did have a golden cross on the weekly. That's obviously a bullish sign for oil. Looks like we might have just broken this trend line to the downside. So there's a possibility it could go back up to $120 to $130 a barrel. That could happen, or this could just be a fake out. We don't know yet. But if it goes back up to those levels, oil traders are going to make a lot of money. Let's just put it like that. So if this thing were to get stopped on the way up, I would say it gets stopped somewhere between about $90 to $95 a barrel. We'll actually put that zone in there just so y'all can see it. So it makes it a little more obvious where this thing could potentially reverse and where it gets stopped. But it is above the support zone. It is, as of last week, above the trend line. So there is that. And the EMAs they look like they are about to have a triple golden cross. So the yellow EMA is already crossed, but the blue and the red have yet to cross. So support below that is 61 to about $76, $77. And then obviously we showed you resistance. So maybe a pullback of about 6% into the EMAs, or just into the trend line, about 1%. If it pulls back into the support, about 8 to 26%. So there's a lot of risk. We trade oil in futures sometimes on a day-to-day basis based on what the market looks like. It does have some pretty big moves, but based on this macro perspective, I mean, not really bullish or bearish on it. As you guys can see, based on the price action since August of 2022, has basically just been a bunch of sideways. So anyways, let's get into the metals. So first one we're going to take a look at here is gold, the little shiny metal that we all love, right? Gold. So it's sitting at all-time highs. I would definitely say that this previous resistance has absolutely turned into support. Yeah, so we have a big, huge green monthly candle here. That indicates that we're at all-time highs, so this thing could definitely push higher. So that new support zone would be between $1,930 to about $2,100. If we do the Fibonacci from the previous swing high to swing low, it basically shows you what the next potential target could be. So gold could push up potentially somewhere around $2,400 an ounce. I know it sounds crazy, but that is what the Fibonaccis are showing. Gold is also getting very close to being overbought, so that's something to keep in mind. Last time we saw that, there was obviously a pretty large pullback from about 2,100 to about 1,600, so roughly about 20%. But overall bullish, I would say. Silver, not doing much, still kind of in no man's land. So support, about $8.50 an ounce to $14.50 an ounce, and $29.80 to $38 for resistance. So there's still clearly a bunch of upside, but if you guys have ever bought any precious metals from a coin shop, you know that there's always a premium that you have to pay to buy them. So definitely calculate that into your numbers when considering that. So next one we're going to look at is palladium. This one's still looking very cheap, but again, we're not going to buy it until it gets into this buy zone. So about $8.90 to $11.50. Resistance would be about 3,000 to 3,400. Let's just say that there is a crazy recession, which we don't think there's going to be. And then, of course, metals are going to moonshot because that's what happens. Just on this metal alone, the move would be massive. It'd be about 115 to 150% to get back to the highs. Whether that's likely or not, don't know. We'll just have to wait and see. So I'm trying to think of what else. So we have... I'm not sure why copper is all the way up here, but we'll take a look at copper too. So it's closer to resistance than support. Copper is generally an indication of demand. So when copper moves up, that means demand is high. When it moves down, that means demand is getting crushed. So we're getting pretty close to that resistance zone. I would say that palladium and silver is a better buy in my opinion, but resistance is $4.10 to about $5.10. Support is $1.28 to about $2. We were there last time, roughly around the pandemic, so that's something to keep in mind. And the last one we're going to look at here is platinum. So this is platinum. It's much cheaper than copper. Of course, in terms of price, it's much more expensive, but in terms of technicals, it's cheaper. So supports between 710 to about 840 a share, resistance 1180 to about 1335 per share. Just to get the move from where we're at right now back up to the peak is pretty good, about 27 to 43% for people that are potentially looking for a hedge and possible safe haven. So last two things we're going to look at here is the dollar index and the VIX. So dollar index is still respecting the trend line, hasn't broken down yet. Again, we don't expect the dollar to start selling off until the Fed cuts rates. That's pretty much what the charts have been proving out with time. There is this support sitting down here that we tested as resistance now turns support. So we still have to wait for those two levels to break and also the EMAs to get a move down to about $95. And yeah, I mean, until we get that, we're just not going to, until the Fed cuts rates, I'm convinced that we're just not going to get that move down. So if there is a move up, it'd be about 7 to 9%. On the other hand, if the Fed shocks us and says, well, you know what, we're going to cut in May, the move down could be as much as also about 8%. So there's that. VIX is doing nothing. It's sitting at all-time lows. The main thing to keep a lookout for here is if the Fed cuts rates and markets freak out and they start selling off, what will most likely happen is the VIX will moonshot, kind of like it did during the pandemic. If that does happen, we will let you guys know what's going on from that perspective. So anyways, this is the macro markets overview for March of 2024. Hope you all enjoyed this content. Please like, comment, and subscribe, and we'll see y'all later. Peace.